The Nasdaq is now tracking almost perfectly along the early stages of every major bubble we've ever seen. So if you look at the charts, you will see that the visual line 6 major historical bubble episodes. The first one is the Great Depression. Everyone knows about the Great Depression. It was a stock market bubble from 1921 to 1932. Then you have the gold boom from 1976 to 1982. Then we have the Japan asset price bubble, 1986 to 1992. Then, of course, we have the dot-com bubble, 1994 to 2002. Then we have the U.S. housing bubble, 2000 to 2009. Then the China stock market bubble from 2005 to 2008. So each series is rebased to 100 at the start of each bubble, meaning every bubble starts at the same point on the chart, index level 100. So we basically trying to mimic, how we started and how they started and where they ended up and where we are. Then the chart overlays the Nasdaq 100 starting from October 2022, also rebased to 100, so that we could compare, where we are, because everybody's telling you there's going to be a stock market crash, and the market is overvalued, and there's going to be a bubble, and you got to be careful, and you got to sell, you got to buy, you got to sell, you got to buy, and you're in the middle of all this, you don't know what the heck is going on. Because at the end of the day, what you need to realize is that the market is driven by emotion. The market is driven by what people think they are going to be worth. The market is driven by things that no one understands. And I could tell you that for a fact that no one understands what's going on in the stock market, because if they knew what was going on, then everybody would be making money. So no one really knows what drives this market. And we're having panic after panic after panic. But that is a buying opportunity. You want to buy when everybody is selling, and you want to sell when everybody is buying. You need to understand that the market, that the stock market, that they, quote unquote, don't really tell you about risk. They tell you about the gains. They tell you about the losses. They tell you to be careful. They tell you to sell. They tell you to buy. But they don't explain it to you. But they don't want to explain it to you, because if you understand, then you also could take advantage of the market while the other way around is going on right now. They are taking advantage of you. Remember a couple of weeks ago when there was basically China said, you know what I'm going to do is I am going to not to give you any more rare earth mineral. And this and the administration basically said, you know what, then we're going to tariff you 100%, and the market collapsed by 2%. And then they say, oh, you know what, never mind, we are just going to negotiate and talk. And what do you think is going on? They're basically playing with you, right? So what you want to make sure is that you understand these charts. Okay, so let's take a look at the charts and see what they're telling us. So the first one is a Great Depression. I mean, everybody knows about the Great Depression. And the Great Depression, and you could see the Great Depression is the one at the top left. Okay, so let's start with the chart on the top left, which is the Great Depression. What does it show? Well, basically, it tells you, it shows you what happened to, as you could see, it went up and up and up, and then it went down a lot at the end, right? When we got hit. So the Great Depression went from 1929 to 1932. So this is the upper left panel. We have the Dow Jones during the run-up. to 1929. We can see a slow, steady climb to the 20s. And then around month 70, the curve explodes and almost vertically. Bam. Then, of course, the crash. Now, at the red Nasdaq line overlaid on top, it follows almost, and this is what's important, it follows almost exactly the same early arc. Okay, it follows the early arc, and you could see the steady rise. You could see the accelerating gains and a momentum-driven surge. The Great Depression bubble, what caused it? Well, it was fueled by massive credit expansion. It was extremely loose speculation and a belief that this time is different. Now, is this what's happening now? Does this sound familiar? Well, today tech market is being powered by AI enthusiasm, right? Everybody wants to get into the game. Record option speculation and the most concentrated market leadership since the 20s. This chart suggests we may be repeating the psychological phase of the 1920s boom. But again, look at where we are. Yes, they're right. There's a bubble somewhere in the future. Well, they say we're all going to die at some point. But that's no prediction, right? So basically what you're seeing that the little red line is following the little blue line and it's catching up, but it is way to go. There is way to go. So this means for you is whenever they tell you we have a bubble, it's time to sell, you should be buying. Until that red line gets to that blue dot, you're fine. Let's take a look at the other one. Let's moving to the top right box. What is that? That is the gold boom. The gold boom from 1976, don't tell me I don't teach you anything, to 1982. Moving to the right box, you see the gold media of the late 1970s. Gold prices soared as inflation, geopolitical uncertainty, and energy shocks led investors to pile into a single asset. Does this sound familiar? The bubble peaks around month 50, then collapses sharply. Once again, the Nasdaq red line is hugging. You could see is hugging the gold bubble's early path. Slow build up, then accelerating gains. What does this mean? What does this matter? Because the gold boom occurred during a period of inflation anxiety. Sound familiar? Fed policy confusion. Hello. And massive geopolitical stress. What's going on with right now between Venezuela that's being bombed? There's a huge aircraft carrier down there. They're trying to make a deal with Russia and Ukraine. Russia's Shadow Fleet got bombed recently. The Shadow Fleet that's going around doing all knows what in Europe with all the planes and the drones, and then you've got China that's doing war games with Russia, and then Russia that is, in fact, I'll do a video on that very soon. But basically, Russia is China is investing in a Russian drone manufacturing facility. What's going on? Okay, so these companies that these companies are concentrated into smaller lanes of investors. Yes, I mean, obviously, one thing that this chart doesn't show, and that's what's going on right now, is who's making the money, right? 7 stocks. 7 stocks are moving the market. So don't look at the market, because then you're reacting to NVIDIA collapsing, Tesla collapsing, then going back up, then collapsing. Remember where NVIDIA was at the beginning of the year? Right? I said, it's over. And now look at it now, 4 trillion. Okay? Don't focus on those names anymore. You need to be fully educated to understand how these names are trading, and they're trading in a very stochastic, algorithmic kind of way, which is very difficult to understand. Focus on what people are not buying, which is the other 493 companies. So if you look at the gold boom, right, it occurred. It's exactly the period that we're in. This comparison raises a powerful question: is the Nasdaq being treated like the new safe haven, the new can't lose asset class of the decade? Now, but again, I'm not saying it's not happening, but if you look at the chart, the top right chart, you see the little red line. Yes, we're following, but there's more to go. There is more to go. Let's take a look at the Japan asset price bubble, 1986 to 1992. Right. So that one, that's the next panel to the left, is the one of the most dramatic in the entire charts. Why is that? Well, take a look carefully, right? It's a straight line. It's a straight line all the way up, and then quite a bit of a collapse again. Okay? You have to understand that the stock market is made up of all these events, what we called fat tail events that no one expects. What I'm trying to make, the case that I'm making here, is that we're on our way, but we're not there yet. So do not listen to them when they tell you it's time to sell, or when they tell you there's going to be a bubble. Yeah, eventually there's going to be a bubble. Okay. So the Japan Nikkei 225 skyrocketed in the late 80s. So we're talking about the asset bubble that went from 1986 to 1992, right? So in the late 1982 to ultra loose monetary policy, property speculation, which we have, and a belief that Japan's rise was unstoppable. Okay, so be careful. Okay. Inflation is on its way up. And that's a different topic, but let me address it for you right now. Is that inflation is on its way up? That's a fact. How much inflation we shall see, but the thing is, you have to be very careful when you have higher inflation. I mean, let's put it this way: it's not going down. I put it this way, right? And look at the prices of food prices. That's going up. One thing you cannot have, and unfortunately, you're going to have it. You're going to have lower rates. They are going to lower those rates in December. That is a bad combination. It's great for the stock market, but it's a bad combination if they cannot control inflation. Now, they're trying to control inflation, the administration, by basically controlling the price of certain items. Saying, well, meat prices are too high, food prices are too high, we got to do something. But the thing that you're assuming that those prices are tied to the tariffs, but they're not. Well, at least not fully. Meat prices are not going up because we're taxing, we're raising tariffs on Brazil. No, that's not entirely true. There's been lots of issues that have caused meat prices to go up. Even if Biden was in the White House, you still would have had it. And the same thing for all other food items. So be careful. You need to understand the facts. And I want you to understand the fact. That's why I want you to join this channel, so at least you understand what's going on, because we're talking about your money. So this Japan asset price bubble, which lasted from 1986 to 1992, the bubble took 30 years to recover. 30 years. Be careful, because once you're down for a while. Look at the red Nasdaq like on that panel. Again, it mirrors the early Japanese buildup almost perfectly. The underlying message is brutal. When valuations get completely disconnected from income, earnings, fundamentals, bubbles form quietly, gradually, and then they burst violently. The Nasdaq current valuation, especially in AI leaders, we know where they are starting to echo the 1980s Japan mindset. But again, look at the red line. We're not there yet. We are not there yet. Still opportunities. Of course, you're going to say, well, but look what happened to our friend Warren Buffett. Right? What happened to Buffett? What did he do? He sold everything last year. He was wrong, I can tell you. He was wrong because he lost a lot of money. How about Michael Burry? Remember Michael Burry from 2008 fame? I used to know him, right? And At that time, we used to deal with the credit default swap market and all these wonderful tools that collapse the economy. And he said, you know what? This economy is going to collapse. The housing market is going to collapse. Therefore, it is time to hedge the entire market. And he was right. So now what he's been doing, he's been hedging the market all along since last year. He's bought put options on the S&P, and now he's doing it again. And he has been wrong. It hasn't really worked that well for him. In fact, he's closing his hedge fund. What happens when you don't know exactly what's going on? So be very mindful of the fact that this is a very complicated it's a complicated environment, let's put it this way, because, if you look at the Wall Street Journal, if you look at Barron's, if you look at Bloomberg, you look at all these people talking to you 24/7, it's pure entertainment at the end of the day, because they're just telling you what they think you want to hear, but what you should hear, you would not understand. If I were to explain to you what drives the stock market, you would not understand literally what I'm talking about. Why? Because it would draw on notion of mathematics. At the end of the day, that's what works. And I tell you, the reason why I know it works is because the most successful investor, Jim Simmons. And who was he? He was a hedge fund manager, right? 20%, 30% every single year for like 2 years. Jim Simmons. Look it up, right? 30%. How did he do it? Mathematician. He didn't do it by looking at, the next Amazon and the next Nvidia. That's for you. That's what they tell you, so that you think, okay, so that's how I make money in the stock market. No, you don't make money in the stock market by looking at the next Nvidia, unless you put all your money in Nvidia and it works out. But that's like gambling, because at the end of the day, you're not going to win every single time. Okay? The way he does it is very succinctly investing in small pieces of lots and lots of stocks. Millions of dollars invested, but not at a shot. A little bit here, there. Makes his money consistently based on mathematical theories. Let me just give you a very simple example. If you're playing with head and tail, right? Head you win, tails I win, right? You say, what are the odds of winning? 50%. How do you know? Well, because there's only two sides. Have you ever tried it? Keep flipping that coin. Tell me when you get 50-50 every single time. You may be getting tails, heads, tails. In fact, someone did it 50,000 times. They did research on that, right? And they found out that it never equals to zero. So that's a principle. It assumes that each spin, each time you flip that coin, the way I flip this coin does not impact the way I flip that coin. So therefore, each event are independent. And in that case, yes, it's 50-50. But we all know that one stock going down impacts another stock. It's a lot more complicated than that. Therefore, it's almost like chaos theory. I know. That's what you need to understand. You need to realize that. That is extremely important for you to understand that it is not that simple to predict the stock market. Okay? Next. This is a doozy. This is a dot-com bubble. And don't forget to subscribe to this channel. Why? Well, because I've done it. I've seen it. Educating it. And I could tell you, they are not telling you what's going on. I mean, let's put it this way. Open the Wall Street Journal. Does it tell you anywhere in there the level of risk that you have in the stock market? Are they quantifying it, right? If you're going to cross the street, you're going to look left and right. You're going to take your chances, because the idea is to cross across the street. I know it's across the street. The idea is to cross the street. The only thing is you don't want to get run over. Japan fits into this because I am showing you the charts, right? You could see the stock market chart for the Japan stock market chart at that time, the Nikkei 225, that went up, and the Nasdaq is following it very closely, and then it collapsed. And the point that I'm making in all these, these charts that you're seeing is basically the red line is us and the blue line is them. We are on our way, but we are not there yet. Okay, so the dot-com bubble. That's chart. This is a fourth chart. This is a great chart. 1994 to 2002. That's how it lasted. Some of you might remember that time. This is a comparison everyone expects, and for good reason, right? The dot-com bubble is the closest, look at it, historical parallel to today's tech environment, because they're saying, look, the dot-com, look, the AI, it's going to explode, it's going to disappear, right? We're going to lose money. Wait. First of all, you need to realize that AI and dot-com is two separate animals. Dot-com, there was nothing. It was literal air. Pet.com, whatever, all these things that just disappeared. AI is a real thing. Believe it or not, Tesla is an AI company. But that's a real company. You may not like the guy or whatever, but the point is that they're making real things that real matter. Right? They have money behind them. They have a profit. They're creating EBITDA. Take a look at NVIDIA. This is not a real company. This is not something that they're selling and they're losing money. They're making money. They're making a lot of money. All of these companies are making money. So be careful in comparing them too quickly. So if you look at the chart, it's a slow rise, right, in the early 90s, followed by a massive euphoric spike after month 60. Look at that spike. It's almost like the Everest. After month 60. And then the spectacular crash when the Nasdaq lost almost 80% of its value. A lot of money. Right? So the red Nasdaq line from 2022 onward is tracking the dot-com bubble almost perfectly through the early built-up phase. You could see it is a line. I want you to understand what I'm saying. I want you to, let's put it this way. I don't want to teach you anything because you could read books about all this, right? How to make money in the stock market. I am here to educate, and education is like kind of put it on into perspective so you could see what the heck is going on, because this is your money. I don't care where you are, because this is a dot-com bubble. Even if you don't have a dollar in the stock market, you are going to be impacted. Okay. So similarities are scary. The dot-com mania versus the AI mania. Venture funding boom, AI investment boom. Remember well, you may not remember, but at that time, everybody was funding anything that has a dot-com to it. They put billions of dollars in it. And now, AI investment, I hate to tell you, they're spending a lot of money. A tremendous amount. In fact, now the news is coming out and saying they're never going to get their money back. They are never going to get their money back. But you need to understand that they're searching for a way. They're looking for a way, right? It's useful. They don't know what to do with it. It's like when they built a car the first time. Nobody wanted to drive a car. I mean, it makes noise. You need oil. It's good. It breaks all the time. I'd rather have my horse and buggy. It's much easier. Why do I need an iPhone with 250 apps? Who cares about the apps? All I want to do is I want to call somebody and I want to take pictures. Remember that company that's gone now? BlackBerry, remember that company, right? Gone. Okay. So that's what's happening now. They're looking. So you have to be careful, because you don't want to be banking the wrong company. So there's extreme market concentration as per the dot-com bubble. That's right. Even more extreme today. I mean, after all, you're paying 150 times earnings for Tesla. Why? In fact, even more than NVIDIA. Why is everybody, spending so much on Tesla? The dot-com bubble took 5 years to inflate before it finally burst. But it took 5 years. 2 years in the AI cycle. Right? We've got time. We're in the middle of the story. Now, of course, that one I know intimately because I was involved. The U.S. housing bubble, 2000 to 2009. We almost lost the economy on that. So take a look. Take a look at the next one. So that's now we're talking about the housing market, and that's the bottom left. Um, I don't know if you take a look at it. That's the bottom left one. So, what are we saying? Well, this one is a bit more problematic, and I will tell you why. Basically, it was a slower, it was credit driven, right? So I think that we reached the peak of the bull market with metals going all the time high. Well, we are getting there, but again, if you take a look at the oil, the gold one, um, we're not there yet. We are not there yet. There's more to go. I'm not talking about the price of gold, right? I'm talking about, I was comparing the Nasdaq here, not the price of gold. So if you look at the US housing bubble, as you could see in the chart, the housing bubble rose modestly, very slow, not vertical, and then plateaued before collapsing. The Nasdaq red line is actually deviates upward, meaning today's tech market is rising much faster than the housing bubble ever did. But then again, I mean, yeah, we're ahead on this one. So if you were to look at the housing bubble, we should be crashing by now. The Nasdaq is now accelerating faster than ever, even the housing bubble, which was considered one of the biggest systemic bubbles in U.S. history. Well, once you lose your house, you lose everything. So that's the only chart where I say, be careful. But then again, we're comparing housing versus the Nasdaq 100, basically tech stock. So, but still, yes. And then of course, the last one, you have the China stock market bubble from 2005 to 2008. Right? This one is short, violent, and textbook speculative mania. The CDS and the MBS were like nuclear bombs when they collapsed. Yes, I used to sell CDS, and I know, right? Because basically, CDS is credit default swaps, and what you did there, you basically, and this is an incredible story if you think about it, is because you were allowed basically to buy insurance on loans and on bonds, which is great, right? And the only thing is, you were allowed to insure assets you did not own. Right? If I buy insurance on your house and your house burned down, I make money. What is that called? That's called gambling. Buy insurance on your own house. You don't buy insurance on somebody else's. Well, with the CDF, with the credit default swap market, they allowed it. They allow you to protect, to insure a loan or a bond that you did not own. The heck is that? Right? It's not buying puts and things like that. It's just you're just gambling, and they allowed it to happen, and everyone allowed it, including the Federal Reserve. Now, some people say, "Be careful what you're doing. That doesn't make any sense. You're going to collapse the economy," and they did, right? Because all these banks were what they were basically. I don't want to make a whole history about the housing crisis, but somebody brought it up, and I think it's important for you to understand. But basically, what they did is that they literally all these banks, and nobody knew what they were doing, including Goldman Sachs. They were basically taking the other side of the trade, where you were insuring $100 million of let's say it was Bear Stearns, or you could insure anything at that time, even Lehman Brothers, if you wanted to. So they say, yeah, okay, I'll take on the risk. It's never going to collapse. This is great money. And then the whole thing collapsed. And then they said, you owe me $3 billion. 10 billion, 50 billion, they didn't have the money. Because why? Because nobody was controlling what they were doing. So then they decided to, you know what? They decided to go to Congress. I mean, take a look at this movie called Too Big to Fail. You don't understand everything. It's a very scary thought. So point back to the China stock market bubble is, the difference is speed with that. China's bubble went vertically quickly, 2005, 2008. The Nasdaq is steadier, but still steep. So the China's bubble was driven by extreme margin trading, speculative retail flow, concentrated market leadership, and a narrative of unstoppable economic dominance. So what does this all mean, right? When you look at those six bubbles put together, all six historical bubbles in the first 20 to 25 months look almost identical. Slow rise, accelerating growth, growing confidence, can't lose, and narrative dominance. So the thing you have to look for is this. You've got to make sure, and don't forget to subscribe to this channel. That's why it's called the Black Swan. You need to make sure, you need to watch out when they don't talk about bubbles anymore. The longer Ray Dalio goes out there, says the market is going to collapse, the market is going to collapse. Or you have JP Morgan's Jimmy Diamond going out there, the market is collapsed, we're paying too much. It's okay. The more they talk about it, it keeps the market honest. And hopefully by that time, earnings will catch up, right? And then they're going to say, you see, it's good. So then they'll push it a little bit higher when they don't talk about it. That's what is meant by growing confidence. That is when you have to be careful because the Nasdaq today is right at the same phase. But in every single of these past bubble, the real euphoria, the vertical melt up happened after month 30 to 50. Right? Banks and bankers should not be allowed to gamble your money for their gain, of course, but they did, and they continue to do so. They continue to do so. Why? I'll tell you why. Do you know how many people went to jail for 2008? One guy, some trader. That was it. No one else was blamed. Why? Well, because at the end of the day, banking, right, allows the money to go through. They know that inherently. Do you think that JP Morgan could ever file for bankruptcy? No, no way. Why? Well, because then the whole economy collapses, and they know it. They don't openly say it. Banks are too big to fail, and I hate to say it, but they're too big to manage. I didn't see it. That happened when the whole thing with Wells Fargo, look at the story. Basically, it's too big to fail and too big to manage. That's a bad combination. Okay? So these charts do not say that a crash is guaranteed. Okay? I want to make sure that you realize that. This is not what we're talking about. What we're saying is the trajectory is matching the early stages of multiple historical bubbles almost perfectly. So sentiment is euphoric. Tech stocks are no longer being bought for earnings. They're being bought because they're going up. This is bubble behavior. No, hey, people make money just because things go up. I don't know if you know the story about Walmart and Instacart, where basically Walmart literally bought Instacart to compete with what's that company, with Amazon. They didn't make any money, but they wanted to keep it away from Amazon, so they bought it. And then somebody did the same thing. And if you look at the Instacart price, it keeps going up and up. And only now did they start to make money. So it's not about how much money you're making. And in fact, unfortunately, you have no choice because, when you look at the market, you look at the news, you look at Bloomberg, right? They equate, they show you news and they show you charts. And you're saying, oh, okay, so when the news is good, the stock market goes up, right? Yeah, that's right. No, not true. I could show you many companies that have done great and the stock is not going anywhere. Take a look at all these small companies. Take a look at all these small cap stocks. Nobody cares about them. Why? Well, I don't know, because nobody cares. But they're doing great. Why is it that a company like, let's take a look at, so you have Tesla, right? 150 times P ratio. And let's take a look at GCT, right? Google Cloud Technology. Great companies. P ratio 5, 6, 7, 8, 9, 10. Growing fantastic. Why not? Because no one is paying attention to them. Until somebody pays attention, nobody cares. So sentiment is euphoric. Market concentration is unprecedented. The top 5 to 7 stocks now make up the largest share of the total index at any point in history. Stay away from these stocks. 3, earnings growth cannot justify the price gains. That is true because you're expecting too much, but you know what? You're expecting too much, so the price, the charts goes like that, right? You say, well, it's too much, it's too much. you're going to have a market crash. So you lose 2%. So you go down a little bit. And meantime, as you're going down, earnings are going up. So it's kind of catching up in its own kind of weird little way. That's why you want to keep them. You want to have them keep saying the market is overvalued. You want to hear that. Because the more you hear of it, right? The more you hear of that, the more it keeps everyone honest. It's when nobody talks about it anymore. Then everybody say, this is sky's the limit. Liquidity is still strong. Investors are betting the Fed will return to rate cuts, fueling more speculation. Of course, that's what's happening right now. The Fed is going to cut rates. I mean, look at what the administration did to the Fed. Pretty nasty. It worked. You may like it, you may not like it, but it worked. And you're going to have rate cuts in December. We'll talk about at some later point about inflation because that could be a major issue. The two things you have to worry about in the back of your mind is inflation and the national debt. When that becomes an issue, then we're all cooked. But as long as the dollar is a reserve currency, I don't think that's going to happen. And let me tell you, the administration is going to do everything to keep the dollar on top, even if they have to go to war for it. Then otherwise, everything is off. Do not underestimate that. But the point is, right now, liquidity is very strong. Investors are betting that the Fed will return to rate cuts, and they will. The thing is that the Fed has the ability to print as much money to keep as much liquidity as possible and keep it going. The psychological pattern matches every bubble. Remember, hope, enthusiasm, certainty, and then invincibility. We are not in the invincibility part yet. So the question you need to ask yourself is, so what do we do with this information? Do not sell everything. Please, don't go for that. But it also, and this is where it gets complicated, it doesn't also mean, well, let's buy everything. No. The message is clear. You need to understand the phase you're in. You're trying to cross a street here. You're trying to cross a street. Where are you going to go? What you want to go across the street, right? So because you want to go across the street, what you need to do is you need to look left and you need to look right. So if the Nasdaq follows the Japan bubble curve, the .com, the China, and all that, we're still years of gain left. But those gains become more unstable. So we've got time to go. Every time you see the market weakening, you buy. I didn't say go and buy an NVIDIA because you're asking for trouble, right? And it's important for you to understand that because remember that 20-year bubble in Japan, the one that collapsed, it took 30 years to recover. Do you know how long it took the .com bubble to recover? 15 years. Be careful. The housing bubble, well, housing prices are going up. No. It destroyed trillions of dollars. So if the have and the must cut rates and inject liquidity in the market, then speculative assets will continue to go up. Yes, but that's okay. Understand what you're buying. Right? Understand what you're buying. That's very important. Know what you're investing into, right? And be aware, what's coming up. And most importantly, be careful who you're listening to. Because obviously it's easy to get, views. Just say, look at Ray Dalio. I mean, he's been saying the market is going to collapse every single day, literally. Now, of course, at some point it's going to collapse. You're going to say, you see, I told you the market was overvalued. I know these things. But you need to understand who's talking to you. First of all, if you're on social media, YouTube, guilty, what are they telling you? Right? They want to tell you what you want to hear. And what you want to hear is, tell me something that's different. Well, the market is going to collapse. The market is not going to collapse. How are you going to use that information? The way you want to use the information is you need to understand what's happening. You need a balance. You need to find a balancing act here, right? You don't want to be too far up, or you don't want too far down either, because then it's pure entertainment. Frankly, they could tell you anything they want. It doesn't matter. But unfortunately, social media is one thing, it's entertainment. Don't listen to Peter Lynch, right? I mean, this is a very good point, actually. I'm sure you would rather read Peter Lynch that says, how to make money in the stock market. Sure, when the market is going up, you can't go wrong. Well, look for the sales, look for the profit margins, look for this. But no one is going to tell you, hey, how about a book, The Uncertainty of Market by Benoit Mandelbrot? Who? The uncertainty of the markets? You're saying that there's risk in it? I don't want to hear something like, I want to hear that I'm going to make money. Right? But yet, Mandelbrot was very closely associated with Taleb Nassim, Black Swan. Taleb Nassim says basically every morning when I get up, Taleb Nassim he wrote a book called The Black Swan, and he was a trader, and he worked with closely associated with a firm called Universa, which made a lot of money during COVID, 4,000%. I didn't make 4,000%. They basically hedged the heck out of the market because they said that people were going to stay home because of COVID. This is ridiculous. What do you mean we're going to stay home? Of course we're not going to stay home. That's never going to happen. And it did happen. So these people, what they're looking for risk in the market. But nobody wants to hear about that. You're looking for gain, right? You want to cross the street. No, you don't want to cross the street. You want to make sure you don't run over. That's the most important goal. Your goal is not to cross the street. Your goal is not to get run over. And unfortunately, in the stock market, they're telling you to get across the street. And that's why most of you are getting killed. But that's a good thing for the others, right? They want people to buy the market or to sell, when was it last week or 2 weeks ago when we lost 2%? We lost another 2% because they say, "Oh, look, the Nasdaq is overvalued. We're worried. Oh my God, but I have so much money. Let me sell." No. You buy when everybody else is selling, and you sell when everybody else is buying.